If you've been watching the AI and data center boom, you've probably heard a lot about photonics. Companies like Lumentum have shown just how valuable this technology can become as data centers demand faster and more efficient connectivity. But today, we're looking at a much smaller company that many investors still haven't heard about, Sivers Semiconductor, ticker SIVE. Most of Sivers' current revenue actually comes from its wireless business, where it designs RF chips used in satellites and 5G infrastructure. But the real excitement comes from its Photonics division. This is where investors see the potential for explosive growth as the industry moves toward next-generation 1.6 terabit transceivers. The company has made several major announcements recently that helped drive the stock significantly higher. In April, Sivers announced a partnership with Jabil to supply indium phosphide laser technology for future 1.6 terabit transceivers. That's important because Jabil acquired Intel's Silicon Photonics business, giving it relationships with major hyperscale customers like Meta and Amazon. If those companies adopt these next-generation optical solutions, Sivers could see a meaningful jump in revenue. Then in early June, GlobalFoundries announced that Sivers laser arrays would be included in its next-generation Silicon Photonics reference designs. This expands Sivers' reach even further because it allows the company to benefit from GlobalFoundries' customer network and sales efforts. Sivers is also involved in co-packaged optics initiatives through partnerships connected to the broader AI ecosystem, creating even more potential opportunities. But investors should remember that right now this story is still mostly about potential. The company hasn't yet secured the massive hyperscale design wins that many investors are hoping for. That's why there are some important risks to consider. First is valuation. Even after recent pullbacks, Sivers trades at a very high price-to-sales multiple. Investors appear to be pricing in future success before it has fully arrived. The company is also operating with negative margins today, which means it needs significant revenue growth to justify its current market value. Second, Sivers depends on external manufacturing partners for large-scale production. If demand for advanced photonic components continues to surge, manufacturing capacity could become a bottleneck. Larger customers may receive priority, which could slow Sivers' growth plans. Still, there are several potential catalysts ahead. Management has discussed pursuing a NASDAQ listing, which could increase visibility among both retail and institutional investors. There's also ongoing speculation that larger AI ecosystem players could show interest in supporting the company's growth, although that's far from guaranteed. Looking toward the end of the decade, the bull case is straightforward. If Sivers successfully captures a meaningful share of the rapidly growing photonics market, revenue could increase dramatically from today's levels. Combined with growth in its wireless business, that could transform the company from a small niche supplier into a much larger semiconductor player. So, is Sivers the next unknown giant in photonics? The opportunity is certainly exciting, and the partnerships are impressive. But at today's valuation, much of that future success may already be reflected in the stock price. For investors, this remains a high-risk, high-reward story where execution will matter far more than headlines. What do you think? Is Sivers an overlooked photonics winner, or has the market already priced in the best-case scenario? Let me know in the comments below. And if you enjoyed this analysis, don't forget to like the video and subscribe for more stock breakdowns.